The collapse of SVB has given rise to a host of wide-ranging discussions. It has resulted in a long weekend of fear and conjecture, similar to the Lehman weekend and other significant financial events. By the time of writing, the situation has temporarily abated. The collapse of SVB was due to a duration gap, a measure of interest risk and the product of an asset-liability mismatch. When short-term liabilities fund long-term assets, such as U.S. Treasury and agency bonds, rising interest rates can generate tremendous losses. Rates on short-term liabilities are variable, while the income generated by the long-term assets, bonds and agencies owned, are fixed. SVB was attempting to address this mismatch by undertaking a process called immunization, which changes the composition of the portfolio to decrease the mismatch, minimizing or eliminating a gap in duration. SVB was in the midst of such a shuffle, but as the losses associated with several early bond sales became known, $42 billion in deposits fled with near instantaneity. SVB's problems are largely idiosyncratic. Like most regional banks, SVB's depositor base was much less diversified than nationwide banks. But in the case of SVB, that narrow exposure came in the form of its depositor base being concentrated in tech startups, a type of firm that not only burns through cash, but quickly and at an unpredictable rate. Consequently, SVB had a more tenuous, volatile deposit base than many of its regional bank peers elsewhere in the United States. No sooner does a firm keel over than calls for a bailout or some other government rescue ring out. The effrontery that attends the call to hurl taxpayers beneath the wheels of the business failure bus is perhaps the most enduring dividend of a chain of government rescues. While the early, official comment from Treasury Secretary Janet Yellen is that there will be no bailout, depositors are reportedly lining up at a number of other banks in SVB's geographic and commercial ambit. It's worth mentioning that vast numbers of banks have large holdings of long bonds purchased at record high prices and rock-bottom interest rates. Although the majority of them are not likely to be as precariously situated as SVB and its dubiously viewed neighbors are, a systemic problem of some magnitude may still lurk below the surface. In conclusion, the collapse of SVB was due to an asset-liability mismatch, causing losses as interest rates rose. SVB was attempting to address this issue but suffered severe losses as depositors withdrew funds. The collapse of SVB is largely idiosyncratic due to its concentration of tech startups, which have a more volatile deposit base. The possibility of a systemic problem may still exist, but it remains to be seen. Subscribe Libertarian Facts.